Hello Proponomics people, and welcome to the Sunday supplement summary from the supplement that was written on the 17th of March 2024. And this week I called the supplement Context is Everything, because as with many weeks I got myself a little bit worked up and a little bit upset with the fact that lots and lots of figures and data are quoted out of context, and they just don't give a true picture of what's going on in the real world. So let me give you a few examples of what happened last week. For example, unemployment was up. And for some people, that was an excuse for a headline saying effectively that the sky is falling or whatever. Unemployment was up to 3.9%, incredibly low. Putting that into context, 6% was seen as the magic number around about 8 years ago or so by the then Governor of the Bank of England, Mark Carney. That was the number at which they were going to start raising interest rates, although that's something that didn't really happen. And then, of course, you could point to Brexit referendum, and then you could point to COVID and all the rest of it. So that also knocked the train off the tracks in terms of trying to increase the interest rate again. Although, interestingly, when it had to happen in a significant way, it hasn't been the crasher of the economy that many people thought that it would be, or certainly not in an immediate term anyway. But there we go, one example of context. Another one would be about growth, right? So this week I focused on, it was quite a big release for macro figures. We had those unemployment data. As I often say, it's not really the unemployment figure that I think we should concentrate on. The employment figure is more important. And that number at 75% is still, 16 to 64 year olds, is still 1.2% below where it was before we went into the pandemic. So fewer people are working, although the primary reason clearly is not unemployment, because that figure looks roughly the same as it did before the pandemic, or perhaps even a little bit better. Certainly taking a sort of 1 or 2 year historical average before the pandemic, 3.9 stacks up really well. But it's economic inactivity, right? And what's really driving that economic inactivity? Long-term sickness. And what's behind that long-term sickness? There will always be these two schools of thought, and as usual, the reality will be somewhere between the two polar opposites. One school of thought is that COVID has offered an opportunity for people to claim long-term sickness and use/abuse the benefit system in order to stay out of work long-term sick, because a lot of the symptoms have been relatively difficult to prove. I'm sure there is some of that going on, but I'm also fairly convinced it'll be a really quite small amount. And the other side is it's all the fault of the NHS and therefore the government, realistically, because the government haven't looked after the NHS over this administration. And you'll know that waiting lists have been going up and up and up. And of course, strikes don't help either. So the ongoing industrial action has also not helped to clear that waiting list backlog. So problematic. Whether strategically now the unions are sitting and waiting for a change of government, hoping for that Labour government that's the hot betting favourite to come in because they think they'll get a better deal. We'll see. It will be tough for Rachel Reeves to sign off anything too salty, because in her first 6 months in the job, she's going to need to prove she is as fiscally conservative as she's saying she is, even though she's the Labour shadow chancellor. So unemployment figures there, growth, and both in GDP. So again, context-wise, the growth of 0.2% in January, positive figures that were released last week. Is it as good as, it's not even as good as November's figure, to be honest, which was 0.21% of growth. The problem has been, it's been very volatile, and there's been more dropping than there has been growing, which is why we're in a technical recession. So that month on its own, not really enough to say, yay, we're definitely out of the recession. UK economy returns to growth. It only shrank in December and it grew in November anyway. Bit of a ridiculous headline, to be honest with you, but this is the sort of thing that's important. So context-wise, we had more down months than we had up months over the last 9 months or so of GDP. But what do we know? Well, we know from following the PMIs, the Purchasing Managers' Indices, that I talk about quite regularly. We know that the services industry has had a pretty good month in February. And later on this week, we're also going to find out how the PMIs, the flash PMIs, are doing for March. So my expectation with good prints in services in the PMIs for February would be we have another month of growth, because effectively services are such a big part of our economy that if services do well, then generally speaking, we do well. The other big factor we always have to consider is consumption, and consumer confidence was more positive than it's been for a long time, although it remains negative. And as I said before, that shocking stat, it's actually been negative since January 2016. Would you believe it? So over 8 years of negative consumer confidence. That can't be good for spending and investment. And I was surprised to see that, because I would have thought that, for example, with a Boris Johnson at the helm before a pandemic, Boris's language was so positive, and the country obviously believed in him quite a lot because they elected him with a very large majority, that there might have been some consumer confidence in those months. But clearly that wasn't the case, or perhaps enough people were already worrying about the emerging reports of a pandemic such that that didn't play out. But there we go. Those are the numbers, and that's where they are. So aside from the services growth in the economy, construction also did okay in January. Now, of course, it's very difficult to measure it month to month realistically, because, of course, things slow down a bit in December. People don't necessarily start big projects the week before Christmas, for example. The notable change in construction on quarter was new work down 4.5%, repairs and maintenance up about 4%. So we always expect more repairs and maintenance in the winter seasons, as you'll know. And as I say, that new work probably more to do with seasonality. Although having said that, it's not been a positive time where you'd expect lots of housing starts. I had a look at the housing starts, and the first 3 months, we got some more figures this week coming out on those. The first 3 quarters of 2023, we were about 8 or 9% down on the first 3 quarters of 2022. So we're looking at delivering fewer homes this year, ultimately, because the starts in 23 you'd expect to be delivered in 24. It doesn't always work out quite as neatly as that, as you might imagine. But what did we learn? New build work is still down over 10% since pre-pandemic. So that's where we are, something to do with inflation, something to do with the toughness of the climate, and of course with the interest rate. And repairs and maintenance are up about 33% since before the pandemic, which is ahead of inflation, of course. So real growth there, realistically, and anyone will know, I think 33% is probably a relatively conservative estimate of how much the price of building work has gone up since before the pandemic. Then it was the RICS house price balance. So that was released, and the number was -10, which was very, very slightly better than the consensus forecast of -11. But -10 is the best print since October 2022. And what does -10 mean? It means about 55% of the surveyors are saying things have been going downwards, and 45% have been saying things are going upwards. And I suggested there's a geographical divide there as well, because quite a few of the prices in the south east have been going downwards, especially in the commuter towns for London, which have suffered the most, as I've talked about before. I then went on to discuss interest rates and the environment, and the 4 possible ways there are for interest rates to go. One, dribbling down quite slowly, so maybe 0.5% will come off mortgage rates and the base rate by the end of 2024. Maybe 3 cuts in the base rate, but I think still probably 2 rather than 3. So mortgage rates down about 0.5%. That's my most likely scenario, over 50% probability. Some people think they'll come down a bit more / quite a bit more. I think that's unlikely. So that would be sort of 5 cuts or 1% plus off mortgage rates. I'd have that at around about a 25% probability. And then the third one would be that we have a significant event that means we have to drop interest rates dramatically. That would take some doing. That's a 5% or so probability, I think, 5 to 10%, probably on the lower end of that though. And therefore, that would take something significant while inflation is still as hot as it is. And then the fourth one is that we would have to raise interest rates. And this is the one that I find interesting because it's such a curveball in terms of where everyone's thinking at the moment. So maybe a 15% probability on that. And we've probably got to add the rounding error of about 5% in there to make those all add up to 100. But if rates went up because inflation was still well above target and was deemed to be particularly hot, or there was an event, say geopolitically in the Red Sea, something escalated and then it meant that there would be more inflation coming through supply chain disruption, then they might have to take action on the upside, which would scare markets and potentially hurt the housing market, actually, if that was to happen. So we do need to take that into account. And then I finished off this week's supplement by taking a look at the FCA mortgage data. It's always good. I'm impatient by my nature, so the fact that it takes 10 or 11 weeks for that data to come out, I find a little bit frustrating, but it is useful because it is comprehensive. And a few things that we learn, outstanding balances these days are about 1.65 trillion. So massive amount of money, but a low loan to value, and they're going downwards. So people are choosing to pay mortgages off rather than take out mortgages at higher interest rates. So worth noting. What we also got through that data, massive increase in arrears. That was all the headlines. And again, this is why I was banging on this week about context, because there was a 50% year-on-year increase in arrears. That is true. How did it stack up compared to 2016, which was the year it was being compared to in the data, highest since 2016? And the reality is quite a lot better than 2016, which won't remind you of a year where there was particular wobbles in the housing market. There was that surprise referendum that did cause a bit of fuss, no two ways about it. But the reality of that fuss was interest rates dropped, they didn't go up. So there was a lot of bluster before it took us 4.5 years to actually limp out of the European Union. It ended up being a lot of fuss about nothing. I also compared it to 2009, 2010, where there obviously was a significant crisis, a bit of a problem, and the arrears looked nothing like they did then. So if you're talking 1.28% of buy-to-let mortgages in arrears at the moment, or in Q4 2023, you compare that to 3.8% in 2009. So treble, realistically, or we're running at about 1/3 of what arrears were in a real crisis time. And still the vast majority, 93% or so, are not in some kind of organised payment plan, which means that the lenders clearly aren't overly concerned and working people into these payment plans. They're just working through what is effectively the normalisation of the level of arrears back to something that looks like still quite low, actually, for a historical average, even if we ignore the few years after the great financial crisis and just focus on, say, 2012 onwards. These arrears look historically pretty normal. And there's really a lot of fuss about nothing, just like there always is. Arrears are staying comparatively low / normalising in the new world interest rate environment. So just want to hammer home that point about context. Context is everything. My view is still that the UK property market is going to have a good time over the next 5 years. This year could be a bit interesting because, of course, the election will change things in terms of the broader country's decision making. There'll be all that uncertainty until we've got the certainty of the next government, who I don't think will be dramatically different from the last government in terms of what they'll be able to do for the housing market and the existing supply constraints. I can't see a Labour administration being able to be more friendly to landlords. That seems unlikely, but the last 8 years have been particularly hostile. And I think the further left side of the argument is starting to understand that if you force landlords to leave, you won't get what you want from the institutional side of things. And yeah, growing home ownership is great, but then the divide between the renters and those who rent out, or those who just own their own homes, starts to get bigger and bigger and bigger. And that's more problematic from a social mobility perspective, which is very important to the Labour Party. So that's everything for this week. I hope you enjoyed it. I'd love it if you would subscribe to the channel if you haven't already, please. And also leave me a comment, a like, share it on your social media or anything like that. It is very much appreciated. Thank you.